And we are live. Welcome everybody to the LSTfi Summit. I'm delighted to have you all joining here. I'm Adam from Staking Rewards, and over the next hour and a half, we have 3 panels with 12 speakers from some of the biggest liquid staking providers and LSTfi protocols in the space right now. We're going to go straight into our first panel, which is on diving into the world of LST-Backed stablecoins. This panel is hosted by Darren Langley from Rocket Pool and will feature OXP from Lybra, David Garai from Raft, and Conor Ryder from Ethena. So passing the buck over to you now, Darren.
Thank you very much, Adam. So hello everybody. I will be your host tonight. I am Darren Langley. I am the general manager of the Rocket Pool core team. Rocket Pool is the third largest liquid staking protocol on Ethereum. We are a decentralized liquid staking protocol, which basically means that anyone can be a node operator with Rocket Pool. We kind of help to lower that barrier of entry. So I am very, very excited to host this panel tonight. For once, I get to be the dumbest person in the room, and I get to learn about LST-backed stablecoins from some amazing experts from Lybra, Raft, and from Ethena. So we'll kind of start with a round of introductions. You know who you are and a brief kind of intro into the protocol that you represent. Maybe we'll start with LSTfi and first off.
Sure. Hi guys. Thanks for the introduction there, Darren. Yeah, I'm OXP from Lybra Finance, so head of commercial. Just an intro on Lybra Finance. We have launched an interest-bearing stablecoin, EUSD. We're backed by staked ETH. However, we've recently just launched V2 of our product, where we actually accept other collateral types now to mint our stablecoins, EUSD, and our new omni-chain compliant and compatible stablecoin, PUSD. So you'll now see Rocket Pool as another asset that can be used to mint those assets. We've accumulated around $340 million of TVL right now, with around $170 million worth of EUSD minted. Yeah, really excited to be on this panel, and good to meet you guys.
Cool, awesome. And Conor.
Sure. Hey guys, delighted to be here. Yeah, my name's Conor. Started off probably in traditional finance in a pension fund for 3 or 4 years. Then made the move into crypto. Worked for Kaiko on the research team for about a couple of years there, and then made the move a couple of months ago to Ethena. And I lead the research team at Ethena. And essentially, at Ethena, we're trying to build this decentralized stablecoin, USDE, that's collateralized one-to-one, taking a delta neutral strategy. And essentially what delta neutral strategy is that you aren't exposed to the price movements on your collateral. So our collateral asset is staked Ethereum, and then we place short Ethereum perpetual future positions on both centralized and decentralized exchanges. And then at the end of that, you have this stablecoin, USDE, that is stable, collateralized one-to-one. Yeah, and then it's essentially like a decentralized stablecoin with decentralized collateral. So yeah.
Cool, awesome. And David.
Hey guys, my name is David. I'm the founder of Raft. Raft is a protocol that lets you generate R, which is our single syllable USD stablecoin. Which is collateralized at the moment by staked ETH and Rocket Pool ETH. So it's 2 different versions of staked ETH collateral. We have also just recently revamped the protocol design. So starting from next week, you can use not only Lido staked ETH and Rocket Pool ETH, but also a bunch of other different collateral types, including Swell ETH, normal ETH, WBTC, and a bunch of other assets. And in addition, we have also incorporated a peg stability module that's based on interest-bearing DAI. So and together with a savings rate of our own. So I think like there would be a lot of new changes coming up, but that's kind of a summary of it.
Excellent. So in terms of kind of a format, I'm happy for anyone to answer questions. Just kind of jump in and feel free to explore your own individual perspectives. So I'll kick off with a very basic question. But what is a liquid staking token backed stablecoin?
Yeah, well, it's exactly as you say. So a liquid LST-backed stablecoin, it's backed by liquid staking tokens. So I think what you can look at now is Lido ETH, is staked ETH. That's a great example of a liquid staking token. So in Lybra's perspective, we take that asset, we use that, users can deposit that into the protocol, and they use that to borrow EUSD. So they have a debt position. With EUSD, it's over collateralized. So a user needs at least $1.5 of staked ETH in order to mint 1 EUSD. which we think is typically a good way for users to, well, ultimately to protect users. So it makes them kind of less susceptible to kind of major price movements and not being liquidated. But I think kind of the main thing with an LST-backed stablecoin, ultimately you're passing on that yield from the LST itself to another asset. In our sense, it's USD, where users can earn up to 8% just holding the asset. So we think it's a great asset that can be used to mint stable goods.
Maybe I can add something to that. I think like what the way I can like conceptualize LST-backed stablecoins is you take this asset that, you know, it's a volatile token, right? Price goes up and down. You can't really use it for payments. You can't really use it for sort of capital efficient way. So what we all do, and what the you know, all of our protocols do pretty much is take this staked ETH and then kind of try to divide it into dollar-sized chunks that people can then use and spend, and leave a little bit of buffer for the collateral, so that in case the value goes down, people can be liquidated and the token stablecoin is still fully backed. So that's the best way I can think that, you know, people can try to conceptualize what we're talking about here.
Yeah, and just to add to that, it's kind of like what the option was before for decentralized stablecoins would be just taking on Ethereum or another crypto collateral asset, whereas staked Ethereum kind of gives crypto protocols and stablecoin protocols that option of a yield-bearing asset as well, which is huge, especially nowadays. We're at the top of a rate cycle in terms of interest rates as well, and we need crypto to kind of be competitive with TradFi yields. And yeah, staked Ethereum kind of allows protocols to kind of pass on a 4 or 5% yield at the very least, and that's your kind of base case. Whereas before, like Shapella, something like that wouldn't have been possible. And we saw like the likes of kind of DAI or any other kind of decentralized stablecoin really struggle for market share in terms of competing with decentralized stables who were able to earn that interest on their collateral. So overall, a kind of staked Ethereum and liquid staking tokens should make crypto protocols kind of more competitive in the grand scheme of things.
Yeah, completely agree. And I think one thing to add to that is if we look at Ethereum and, you know, the percentage of the amount that's been staked, you know, it's still pretty low. You know, it's around 22% right now, I think. So I think all of us, when we're building these products, when we're looking to kind of scale these for the future, we're looking at that percentage rate to grow, obviously. Whether that will kind of still be focused and be distributed towards Lido or other main players, that remains to be seen. But I think for all of us, we're bullish on Ethereum at the end of the day, and this is kind of why we're building these products on LST-backed goods.
Yeah, and perhaps not even just that, but also like staking participation grow, and as a percentage of that, liquid staking participation will also grow. So we hope that liquid staking will be a bigger part of the pie as well, which seems to be happening. So it's a good thing.
Yeah.
Yeah, we're certainly seeing that happening. It is great to hear that decentralized alternatives are kind of competing with centralized kind of providers. Decentralization is definitely pretty close to my heart. You know, why are more decentralized stablecoins needed, and why are they important to the ecosystem?
I don't mind kicking this off. I mean, from my perspective, I think that the main issue with centralized stablecoins is number one, regulatory compliance. I think we're seeing a lot of pressures now from governments who are going to be launching their own stablecoins, which, you know, ultimately is a threat to the stablecoins in the crypto space. I think one way to kind of combat that is of course to launch a decentralized option, which is, you know, it cannot be censored. It's available to everyone, and is kind of much more resistant to that government regulation, I would say. I think another thing to add, just from our particular case with Lybra, you know, we're an Anon team, really just to add to that decentralized effort, you know, to keep things as completely decentralized as possible, without having that main, you know, one actor in the space to control things. So for us, decentralized is kind of the number one point for us to get across.
Yeah, fully agree with most of that as well. The key point, I think, is that, like, what are we trying to actually do in DeFi? And really what we're trying to do is create this alternative, like, parallel financial system. And we're not trying to essentially copy the old financial system and just put it on a blockchain. There's uses to that as well, but the true kind of ethos of DeFi and crypto should really be based with like decentralized collateral and decentralized stablecoin as as the foundation, whereas that's really not the case at the minute. Like DeFi, if you look at the kind of share of stablecoin volumes, DeFi runs on centralized stables at the minute. USDC, USDT make up about 80% of volumes for stablecoins. And then, yeah, you just kind of got to ask yourself, really, what's the point of it all? We need, I think, to really stick to the ethos of crypto and DeFi, you need that decentralized stablecoin to be, or a bunch of decentralized stablecoins to be more foundational assets. And it kind of boils back to what I said before about staked Ethereum and LSTs unlocking this new kind of competitiveness for decentralized protocols, that we can now kind of match the yields available on TradFi, and we can get more competitive. And as the guys said, as staking yield kind of rises, or as staking participation rises, I should say, that should only kind of increase the competitiveness of DeFi stables. And yet the market would be kind of all the better for it.
Maybe there's one thing I can add here is, I think from the user's perspective, the most tangible difference is that all the centralized stablecoins are, they basically offer no yield, right? Because of various regulatory reasons. So what happens on the issuer side is that they, get the bank deposits, they invested in a variety of government bonds, they make 5% or whatever is the current prevailing rate at this point. They keep all of that, pass none of it back to the DeFi customers and the people who are using the stablecoin. And this makes DeFi lose its competitive edge overall over TradFi, because there's no place to get this riskless 5% yield from. So what we're trying to do and what we're trying to solve is to either bring these yields somehow on chain, which is a lot of protocols, what they're trying to do, or create alternatives to this yield, and then have that form as sort of like a base APR for all of our stablecoins. Maker is doing that through real world assets, and then we're doing it through taking fees and passing that back onto the customer, or taking the yield, taking the part of the yield, and then passing it back to the stablecoin holders, and just try to compete in this way. And we can do that because of decentralization.
Excellent, yeah. So obviously, to be successful, you guys need to be stable. The clues in the name, a stable coin. So what kind of risk tolerances do each of you kind of like take, and at a high level, kind of how do you maintain the kind of stability?
I can start there. Just kind of probably because we're probably more unique in that we're taking that delta neutral approach. So essentially trying to hedge away any of the price risk involved with Ethereum and staked Ethereum as the collateral asset. So there's been other attempts at delta neutral stablecoins before. I think UXD was an example on Solana. They only actually touched decentralized perpetual futures, so they kind of struggled with scalability. We're taking steps to access both centralized and decentralized liquidity, and then we're accessing essentially centralized exchanges via custody partners. So that's that's our main risk, essentially, is making sure that that custody risk is accounted for and that we're not exposed to any kind of counterparty risk on exchanges. And by using those custody solutions, we're kind of keeping the assets safe, separate to the exchanges. The exchanges then mirror the assets that are in the custody. And that's the kind of risk we're thinking about on that side. In terms of the different LSTs, we're trying to kind of keep our basis risk. Basically, is that we're taking on staked Ethereum collateral and replacing short Ethereum perpetual futures. So we need essentially the two assets to be as close together as possible, as in staked Ethereum, Lido staked Ethereum, and then Ethereum itself. So if the liquidity is there for any other liquid staking token, that's fine. We're pretty agnostic to which staking tokens we take on. On day one, we're starting with Lido staked ETH because that's the most liquid and it's the closest to Ethereum, limits our basis risk massively. And then hopefully, as we said, like kind of liquid staking takes off, there's more optionality there in terms of liquidity with other LSTs. But yeah, that's how we're thinking about risk anyway.
I think ultimately, like what we've seen in a lot of different stablecoin designs around the market, and I think like Aves Go, for example, or a bunch of these new designs, is that the tokens, that stablecoins tend to trade a little bit below peg. So it's not at $1, so it's at like 97 cents, 98 cents, 99 cents, something like that. And I think one of the things that we all try to do as founders of protocols is that we try to incentivize as much borrowing activity as possible. And sometimes these borrowing fees tend to be a little bit too low. So what people do is that they borrow at a very low rate, 0.5%, something like that. And then even if the coin trades at 99 cents, it's probably still worth selling it at that point, because even if that 99 cent, like 1 cent difference plus another 0.5% still only adds up to maybe 1.5, which is still cheap, still a good deal. So what people do is they end up like in these like loops where people borrow and then sell to leverage up, low fees, and then that kind of makes the peg go a little bit below a dollar. So in our case, what it's all about is that we have to give the stablecoin holders some reason to hold the stablecoin, and that reason is normally yield, right? If you give stablecoin holders some sort of yield, they'll actually buy it and hold it. And I think for Lybra's situation, it actually worked pretty well. So I think like that sort of is where the industry is going. So we're probably going to see, and I think we've just seen a similar proposal from Frax today on the forum to create their own savings rate as well. So I think like DAI moved first. Now 5% is the riskless yield in DeFi. People who are not living up to that 5%, they're going to be trading below peg sooner or later. So I think this is where we're going. And I think everybody will somehow have to incorporate a yield element to their stablecoins.
Yeah, I'd agree with what you said there, David. I mean, we mentioned stability, and that's right. With a stable coin, they should be stable. I think with the USD, we did see some kind of upside to the peg. And again, it's a premium stable coin where it's, people are earning yield just by holding it. So we noticed there was a deviation above the peg. And I think with the launch of our V2, with the new deployment of the LP as a EUSD 3-curve pool, things are looking to be solved in that manner. Again, we're launching a stability fund, which again is going to be used to kind of control that peg. But then really just back to the risk profiling, as we mentioned to start with. Again, agree with the guys what they've said here. I think otherwise what to add is, with Lybra, for example, we have individual kind of liquidation pools for each LSD that's used to mint our stablecoin. So I guess you're kind of limited in respect of, if one asset goes bad, it doesn't create bad debt for the whole protocol. I guess another thing to add is when we onboard new LSD collateral, that will kind of coincide with the DAO launch, where we put these proposals to a DAO. Kind of the team themselves write these proposals. So again, we would expect them to also add to their due diligence and to kind of represent their token and to show the risk factors that they've presented for the DAO to vote on. And then finally, audits. I think it's all good looking at these LST tokens, but also we need to look at our own protocols ourselves. And for us, audits are very serious. They're something that we'll kind of never skimp on, because we understand that there's a lot of hacks in DeFi, and it doesn't matter how safe an LST asset is. If your protocol gets hacked, then it doesn't matter. So anything that you can do to mitigate that is number one for us.
Brilliant. So kind of a specific question, but what are the collateralization requirements for kind of each of your different protocols?
Maybe ours is like 120% right now for Staked ETH and Rocket Pool ETH. But I think what we need to do when we kind of set these limits is to look at first of all, look at how the liquidation model works on each protocol. We have instant liquidation, so pretty much like all the collateral gets taken out in the same block as when the price drops. We've seen that in this little bit of a dump that we had not so long ago that works well. And then also it depends on what the fees, how much are the fees that our liquidators get, and also have to look at like what the current liquidity is and what the slippage would be, for example, and what the price impact would be if all the collateral was liquidated. So you have to take all of these things into account and then tweak it for your own little liquidation model, and then come up with something that you consider safe. The thing is, there are different approaches out there. So for example, Maker uses a pretty high collateralization ratio, collateralization requirements, something like 150, 170% for Staked ETH, for example. But they have a completely different liquidation model. It's like an auction base. It takes a long time. You get advance notice, everything else. The reason why we can have a lower one, which is 120, and still be safe, is that all the liquidations are instant. So you don't get advance notice. If the price dumps, you know exactly what your liquidation price is. If it goes down below that, you're liquidated. And actually, we found that users prefer that sort of thing because they can, there's a big drop between 150 and 120. It's a big difference. And then if people know exactly, like at 120, you're going to be taken out and you lose 20% of your position size, it's a big liquidation, but you know when exactly that is. People who are looking to leverage up, they're a little bit more comfortable with that. So this is why we chose this sort of liquidation method together with a slightly lower requirements. But we'll have a bunch of different asset types coming online next week. And yeah, it will differ slightly based on what the collateral is.
Yeah, I mean, from Lybra's perspective, we our collateral ratio is 150% as a minimum for minting EUSD and PUSD. I mean, I think ultimately we could reduce that. I mean, people may ask, why don't you reduce that? And ultimately, you'll be able to get users to mint a truckload more EUSD. But I think for us, that's the way that we're going in terms of keeping EUSD completely over collateralized at that level. I think when we launch the DAO, we expect there to be proposals for people to look to try and change that collateral ratio, whether it's uniform against EUSD and PEG USD or whether it varies on each one. I think we have kind of got tools in place where users can, still try to maximize their loans. So we have something called a collateral ratio guardian, where users ultimately can set their desired collateral ratio on the protocol, and if that percentage ever drops below their desired rate, so long as they have EUSD in their wallet, the protocol will auto repay their debt, so to bring them back to their preferred collateral ratio level. And for us, that's kind of it's been useful. There's been one example where it saved a user being liquidated for $800,000. So that's kind of a good thing that we think. We don't want people to get liquidated on Lybra. Ultimately, we don't want anybody to get liquidated. We're here for kind of, Ethereum to do some great gains over the next few years. But these are the measures that we have in place, and they seem to be working well right now.
Yeah, I kind of talked about it already, but Ethena's collateral ratio will be 1-to-1, kind of 100%. That's what the kind of delta neutral strategy affords you. We have the end goal of basically trying to get in the hands of 100 million users rather than, let's say, 1,000 DeFi whales. And we think when you look at the kind of DeFi stablecoin space over the last few years, it comes back to how competitive DeFi has been with CeFi, and the answer is really not very on the grand scheme of things. That you need to kind of have a capital efficient stablecoin. You need to have a stablecoin that can scale and that can compete with the likes of USDC and USDT if you are aiming to be a foundational stablecoin of the ecosystem. And there's obviously varying degrees to that. But yeah, essentially a capital efficient stablecoin is needed to compete with the solutions out there in CeFi, we think. So so that's the thinking behind the kind of delta neutral approach.
Actually, there was actually a question from the chat while I've kind of got you there. So if Ethena is using the perps and futures to be delta neutral in a bull market where funding rates are consistently negative and above the ETH staking rate, does this not erode the value of the stablecoin? I'll throw it. That's a question for the chat for you.
Sure. I think that's one for me. No, yeah. So essentially in a bull market, because we're on the short side, essentially funding rates would be that the long side pays, because obviously there's more demand. The way the funding rates work is if there's more demand for the long futures position, the long futures holder pays that fee. So in a bull market, that fee would obviously increase, and that actually goes to you on the short side. So that's the kind of benefit there. We'd be more concerned about a bear market when funding dips the other way, and maybe that's what the comment kind of meant. So I can deal with that. So essentially, yeah. So firstly, you're really only concerned with when the funding rate dips below the Ethereum staking yield, which is whatever 4 or 5%. So for context, Ethereum funding rates are positive about 75% of the time, which means 75% of the time you're earning the yield on the short side. And then when you actually account for the staked Ethereum yield as well on top of that as a buffer, really you're only actually paying out the yields only like 11% of the time. So on 89% of the time, the insurance fund on the side is getting collateralized, building capital for instances when the funding rate does dip to negative. The insurance fund will step in that instance. There's been the kind of whole idea was built around Arthur Hayes' idea surrounding a Bitcoin delta neutral stablecoin. But we thought obviously this comes back, it's very relevant obviously for the LSTs. It's like we thought basically staked Ethereum does give you that extra buffer. We saw it in the data there. It's about 15% extra buffer of days when the insurance fund is actually getting drained. And then, yes, also there's kind of like mean reverting properties of funding rates as well. So Binance and Bybit account for about 50% or more of open interest in the market. And they have positive baseline rates of about 10% annually. So look, yeah, we have about 3 years of data now on funding rates. And there's information out there if you go onto Athena's Twitter account on this exact topic on funding rates. But essentially over time, they've averaged 5-6%. But even in bear markets, this is to the short side, even in bear markets, say 2022, the average funding rate was still 0.5% paid to the short side. So we're confident from that side of things that, yeah, there's not much risk of the insurance fund getting drained.
Cool, good. So what do you think the role of LST-backed stablecoins will be in the future of DeFi?
Again, I don't mind starting here, and I think again, sorry to keep it so relevant to Lybra, but I think our vision for the space with our LST-backed stablecoins is really to look at targeting DAOs, simply to swap USDC holdings to our stablecoin, which earns interest. I think kind of another big vision of our strategy with EUSD and PUSD, but specifically EUSD, is to look to get these on big centralized exchanges, to ultimately hope that people will swap their stablecoins, which in a way lay dormant, they're not earning any interest, and look to swap those to EUSD, where they can simply earn interest just by holding. And I think a good example could be, let's say you hold EUSD on a centralized exchange and you place a limit order, you could still be earning interest on that limit order whilst it's waiting to be hit. So kind of that's just one, strategy, but ultimately it's to free up capital and to help people be more capital efficient and earning more yield on their stable coins.
Yeah, I agree with that. But what I would also add is, like, ultimately what we're trying to do is to make sure that the LSD yield in one form or the other, so in the form of fees, whatever fees they are, borrowing fees, minting fees, liquidation fees or whatever, they will trickle down somehow to the users of the stablecoins, to the holders of the stablecoins. So we can sort of, and in our case, what we're doing is we're trying to combine the yield from real world assets with the yield that these LST opportunities give the users. So people who want to leverage up, people who want to borrow against them, combine that with the yield that we can get from real world assets, and then pass that on to people who are holding R in the form of the R savings rate. And then this kind of can, in my opinion, this could be like the foundation of the next generation of DeFi, where we have higher yields. We kind of incorporate the elements from TradFi. We take the yields, not take the yields, but we kind of generate fees from all these LSDs, and then kind of try to give those back to the stablecoin holders. And then that will create the new wave of adoption for stablecoins in general. We're hopefully going to see a lot of L2s taking off, reducing fees, speeding up, so that payments use case will hopefully come back to life. And then hopefully these stablecoins that are backed by LSTs can be the coins that are actually used for transactional purposes on all the L2s as well.
Yeah, I think if we're looking ahead to the future, I think one really interesting element is that, like right now, we're at basically the top of an interest rate cycle. Rates are as high as they're ever going to be, and it's the most tempting it's ever going to be for stable coins to bring on real world assets, to bring on treasury bills to earn that 4 or 5%. But what happens in 3 or 4 years' time when interest rates are back down at, let's say, 1 or 2%, whereas maybe staked Ethereum and LSTs are offering 4%, 5%, restaking tokens even higher. So looking ahead, there's a very possible chance that liquid staking token yields are like 2x the TradFi yields, and then we can really see kind of the adoption of LST stables kick off, which is really interesting.
So I think a future where liquid staking tokens are a primitive for lots of different things it makes me very excited, but obviously I'm quite biased. I'm loving seeing kind of like decentralized stablecoins coming through, or using decentralized collateral. That's absolutely fantastic. So yeah, each of your protocols, I've been really enjoyed kind of listening to each of your different approaches, and yeah, thank you very much, guys.
Thanks, everyone.
Thanks, guys.
Yeah, thanks everyone. I'd just like to echo what Darren said. It's great to get all of you together in one place to talk about LST-backed stablecoins. So yeah, really appreciate you being here, and sorry we've only got 30 minutes. I'm sure we could have went on for a lot longer. So yeah, going into our next panel, the second panel, we're going to be taking a short 5-minute break, and then we're going to be coming back with Jordan from Stakewise, Ken from Pendle, Richard from Prisma, and Rostyslav from Asymetrix. So see you back here in 2 minutes. And thanks again, guys. Great to have you here. Going into our second panel of the day is Revolutionizing Yield Opportunities. Going to bring in Jordan and the panelists now, straight away, so we can get things kicked off. And passing the buck over to yourself now, Jordan.
Hello, thank you. Are we all in? Okay, awesome. All right, hey guys. Yeah, welcome to the second panel. And this one, as you mentioned, is looking to explore the different yield opportunities that are available, that are unlocked by liquid staking. And, I think it's fair to say liquid staking has grown tremendously over the past year. And one of the main benefits is being able to use the value of your staked capital in DeFi. And so on the panel today, we've got various different protocols that allow you that provide utility for liquid staking tokens. So I think it'd be good to kind of start off and get an introduction from everybody about what your protocol is, and also, but more specifically, like how can people actually utilize LSTs with you guys. So Ken, do you want to kick it off on the Pendle side?
Yeah, happy to. Thanks for teeing us off. So my name is Ken. I lead the institutional business at Pendle. So working with proprietary trading firms, crypto yield funds, exchanges, and wallets, and so forth. Anyone who's large holders of capital looking for opportunities in the fixed rate markets that we provide on Pendle. So Pendle facilitates a market for fixed rates in DeFi, and also facilitates the ability to trade the direction of yield movements instead of prices for a variety of yield-bearing assets in DeFi, such as LSTs. So excited to be here and chat on the yield markets.
Awesome, thanks, Ken. Great to have you. Richard, do you want to shoot now?
Yeah, for sure. Hey, everyone. Thanks to Staking Rewards for the invite to this summit. So I'm Richard from Prisma Finance. For those who don't know us, Prisma is a new LST-backed CDP protocol. We launched last Friday, hit a TVL of 20 million in about an hour, and the debt cap for this guarded launch of 20 million of our stablecoin MKUSD in about 8 hours. So users are going to be coming to our protocol for something similar to the previous panel where they're depositing their LST tokens for a stablecoin, which can be used in various different places and ways to earn extra yield on top of what they're getting with their LST tokens.
Awesome, thank you, sir. On the Asymetrix side, it's your turn.
Yeah, hello everyone. Thank you for the invite. So first of all, I'm a CTO of Asymetrix protocol. My name is Rostyslav, but foreigners usually call me Rosty because it's easier to pronounce. So you can also call me Rosty. So first of all, inspiration for the Asymetrix protocol comes from the traditional finance instrument called premium bonds from the UK, which has overall like 100,000 of billion in assets and used by 22 million of people. So it's like a proven success story and proof of concept. And this idea we took and actually put the mechanism on chain to be more transparent and see how it performs on chain.
Awesome. Thank you, guys. That's great. I suppose I should also do a quick intro on my side as well. So I'm the business development lead at Stakewise. We been providing liquid staking now for over 2.5 years. We're the first non-custodial liquid staking platform on Ethereum. And we're about to launch Stakewise V3. It's essentially like a second generation liquid staking protocol building on the designs of obviously ourselves, Lido and Rocket Pool and others. Yeah. The TLDR there is that it's basically a white label liquid staking solution, unlocks lots of different interesting things like allowing solo stakers to mint a liquid staking token against their own node. There's also a lot of demand that appears to be on the institutional side for liquid staking too, which V3 solves for as well. So yeah, excited to get that live later this month. But back to the panel then. So okay, LSTs, I think we're all in agreement. They're fantastic. And what would be kind of interesting to hear is, actually, let's start with you, Ken, on the Pendle side. Is I'm kind of interested to see the interest rate. You mentioned about the ability to trade yields, right? This is something that's very, very popular in like the traditional finance markets. And so I'm kind of intrigued to see how you're finding the demand in the DeFi space, but also more specifically, like who are you seeing are the users of this protocol? Like IRS's interest rate swaps can be quite complex instruments. Are you seeing more demand on the institutional side, or is it purely the retail and the degens just going at it on your protocol?
A little bit of both. So I think anecdotally, we have at least 25% of our TVL from institutional entities. So these are usually prop trading firms who have a lot of flexibility on the mandate to invest. And I think in general, I would say the demand is strong, but definitely room to improve on awareness and education on the markets. I think you hit the nail on the head with how the product can be perceived as complex. And it is complex if you look at traditional interest rate swaps. They're typically traded between very large entities like banks, mortgage business, credit hedge funds, and so forth, insurance companies, to hedge their positions. And I think this is where the educational aspect comes in very strong. This is somewhere we allocate a lot of focus and priority to simplify the product, to basically educate users on the different use cases, simplify the user goals, and make sure that they have the tools and the right strategies that works for different user profiles.
Yeah, I think that's absolutely fair. I actually used to sell interest rate swaps as a living back in the day, so very familiar with that side. But yeah, again, I was working for a bank and selling mainly to banks. So you touched upon an interesting piece, though. It's just simplifying the protocol and making it easy to understand. Like this goes for, I think that's one thing we do massively at Stakewise, is just trying to think about how we can make things as simple as possible. So I guess the guys at Prisma, how are you finding like simplifying your platform and also educating users? Do you find that you're having to educate them on liquid staking, or are all of your users already well aware of liquid staking and you're then just educating them on the stablecoin market? Like how do you approach that whole market?
Hey, well, we are fairly new, but definitely the education is something in the pipeline in terms of content creation, engaging with people in our channels. I think one of the big things though is with respect to the UI. How can we make things easy for somebody to drop into a given LST directly with Ethereum this type of thing. I think if we can provide an easy interface as well as the education for what you're getting, and try to provide guidance to use the system in a safe manner. You see this everywhere. I think even before the DeFi, the early decentralized finance boom, it was like there's a lot of education that needs to happen to general users with how to use some of the protocols that are already around. And so things are getting a bit more complicated. I think you'll see like your liquidity users that are using liquidity style forks like ourselves will be very familiar with this. But then as new people come in looking for these LST style yields, I think the panel before talked about it a little bit. Some of these things that are being made, including ourselves and others, are going to bring new players or people looking for these LST yields that are maybe more than just depositing into something like Prisma. And so it's going to be a little more complicated. And so I think there will be ourselves and then services that build on top of us that will help to make this sort of easier in terms of the user interface, and hopefully the education side is taken care of. I know we're talking to other protocols as well to see, people you might think that are competitors with us. We're discussing things about how we can sort of work together to make sure people understand how everything works in a more simplified manner.
Got it. That makes sense. And you mentioned about people building on top of you, and I want to come on to that point in a second as we think about like the risks that are associated with like effectively the Legos of DeFi. But Rusty, I just wanted to quickly ask you, like, who are you seeing as the main users of your platform? Like the premium bonds market in the UK is obviously very retail driven. Is that the same kind of feeling on your side?
Yeah, I think that retail is the most important use case here. So basically, people, let's imagine that the user have 1 or 2 Ether on his wallet. Then the user can go and stake it, for example, with Lybra or any other protocol, and get kind of 5% more or less yield in the end of the year, which for 1 Ether will be too small. But what we offer for this kind of person is that he could go and not risk with his body of like 1 ETH. He could go and deposit his 1 staked Ether to our protocol and get chance to win a lot in a short period. Yeah, so could be more interesting than just regular yield, which you could earn with kind of Lido platforms. So, and also if you're talking about institutionals, it also could be interesting, because from the institutionals perspective is that, like if you have a lot of staked Ether, you always can just earn like 5% more or less. But also you could risk a bit. So the chance of winning of the whale inside our protocol is huge. So you get a chance to win more than usual 5% if you're like talking on the period of the year. So also could be interesting.
Got it. Yeah, that makes sense. That makes complete sense. Alrighty, so Richard, just going back to the point you mentioned about having other protocols built on top of you, I'm very conscious that all of your protocols are built on top of LSTs. And so I guess one of my things I'm interested in, and one of the things that I think about on my side is when I look to get Stakewise integrated with protocols is what is their risk management? Because at the end of the day, if we're putting Stakewise users exposed to third-party liquid staking protocols, then that's kind of out of our control. And it's great to get a better understanding of how the protocols that integrators manage the risks of these underlying protocols. So, Richard, maybe you want to start, given you mentioned it to start with. Like, how do you manage the risks of the different LSTs that you build upon, or minimize those risks the best you can?
Yeah, that's the word. I guess it's how do you minimize the risks. So. Prisma out of the gate created sort of a third-party Prisma risk team that's teamed up with Lamarisk, and so they will go over all of the LSTs. And I think it was talked about a little bit in the previous panel as well in terms of amount of liquidity, oracles, how much slippage is on chain, how much slippage would occur in a liquidation on chain, different things like this are the things that we try to look at, and we create sort of a comprehensive risk report. And so we tried to go with what we thought were the main LST protocols to start with. And as we go forward, we have other protocols approaching us, and we will do this risk assessment. And these new tokens will be listed via governance. And so it will require some education and guidance. And again, using these risk profiles to sort of guide and teach the community along. I think that's how we're handling it internally. I think just as a global sort of thing, stepping back, I know you didn't ask this, but I'll just throw it in there. I think over time here, as we get through this market, you'll see some of these LST-backed stable systems mature, and then the LSD protocols themselves might look to enable more yield with these different protocols that they decide, hey, these people are doing it right, or these people have communicated with us and we've been working with them, and we understand that they're taking risk, seriously. Or we like how they're measuring risk and we're working with them to make sure that they're doing it in a way that we're happy with.
Got it. That's clear. And what about on your side, Ken? Like, how are you managing the risks? Like, are the risks between each LST isolated? What's the worst case scenario, I guess, if like an LST goes down on the Pendle side?
Yeah, I think there are a few different elements of risk in Pendle that we think about. So the first that I would think that I usually highlight would be the lack of inherent leverage. So outside of LSTs, like just how Pendle works. I think the simple way to think of Pendle is as a spot market for yield trading. And this has an interesting relationship between the principal and yield tokens on mechanism on Pendle. It may not be as capital efficient as some, I guess, more aggressive traders would like, but I think it's a good start, a good way for us to start without worrying too much on the price and risk management side. With regards to the underlying tokens, in this case, LSTs, I think the most inherent risk would be on the smart contract side, given that we build upon other assets, including LSTs. For every single new pool that we spin out and launch on Pendle, those pools are audited prior to deployment, every single pool, every single maturity. And we do have a panel of 6 auditors that we review from time to time.
Got it. Yeah, that's good to hear. I think that's a pretty smart move on your side. And so, Rusty, on your side, kind of changing the question here, one of the key things that's the reason why LSTs are so popular is because they're effectively composable. You can take these LSTs and use them across different platforms. When somebody has utilized their staked Ether with Asymetrix, are they then still able to then utilize it again elsewhere? Do you have that composability layer on top of Asymetrix?
Yeah, thanks. Good question. Yeah, of course, composability is one of the important topics of any protocol, and we're working on this direction. As for now, we don't have any proposals for our stakers in our protocol where a person could go and use their kind of LP token from our Asymetrix pool, but we're working on this. I can say that in future, of course, there would be a lot of opportunities to use this kind of LP in different protocols in different ways, maybe even with kind of a collateral. But for now, it's not possible. But of course, we're working on this direction.
Got it. Yeah, that's good to hear. And I think one of the best ways to accrue TBL, I think, in this space is having that composability layer on top. So people can utilize your platform and then go off and do something else with their capital. So, and maybe Richard, coming back to you on your side, like, I think obviously as a stable coin, I think the composability and the utility for the stable coin is almost is paramount. So what are you doing on your side to ensure that users can actually do something with their stable they mint via Prisma?
So out of the gate here, we do have some pools and other places where users can deposit their MKUSD and earn some yield off of that. I think if you look even to the earlier stable coins, the early projects, your Ampleforce, ESD, and what was the other there, Basis and stuff like that, it took a while for them to get enough, enough quantity of their stable coins such that it could be used around the different parts of decentralized finance. So I think we'll see where it goes. Right now, we have sort of a plan in terms of working with a bunch of the partners. Prisma's partnered with a lot of different protocols in decentralized finance. So we'll sort of see where that goes. At the moment, there's a couple of pools that are available on Prisma that sort of to provide a start as a place to use it, and of course the stability pool on this fork. So I think it really comes down to creating a much larger base of the stablecoin before we can look to use it in lots of other places, because it is attractive to use the stablecoin in a system that is based on liquidity. And so we're going to have to see a little bit how the DAO forms and where they decide to push emissions, because that is one thing that will be integral in Prisma, is the DAO is going to be able to decide where to push some incentives. And I think that's sort of what's going to lead the token, the stablecoin around decentralized finance for us.
Got it. Yeah, that makes sense. I think often it's a bit of a chicken and egg situation where, you know, you want to spin up the TVL for your token, but then often people don't want to be minting it unless they can actually do something with it. So you're in that interesting phase where you're having to bootstrap to get the supply before you're then able to, you know, really start providing some true utility and integrations for it.
Precisely, yeah.
You did touch upon liquidity though, which is an interesting topic, and I think one that we all think about way too often. So actually, Ken, on your side, you know, Pendle is one of, you know, I don't want to say many. There's a couple of names in like the yield splitting space, and I think one of the biggest issues that's always existed with yield splitters is the liquidity side, like having enough liquidity to efficiently trade both the principal token and the yield token markets has always been a barrier. So I'm kind of interested to hear how you guys are solving for that on your side.
Yes, I think I think very good point. Purely relying on the Pendle AMM is going to be hard to scale. I think we've done decent in terms of adoption. But if you look at the TVL versus our trading volumes, it's actually not very TVL efficient. We have roughly 150 million TVL against 2 million trading volumes. If you compare that with like GMX, it's like not even close in comparison. So we are introducing, hopefully by end of the year, more advanced yield trading features such as limit orders, RFQ, and OTC markets. And again, the inspiration comes from how, and you're probably more familiar with this, with how interest rate swaps work in TradFi markets, where everything is essentially OTC. So this would essentially build an additional layer on top, a layer of liquidity, which takes some stress off the AMM that is separate. Yeah.
Got it. That makes sense. And correct me if I'm wrong, but I think like your tokenomics is quite a popular model right now, and has been a key thing for like spearheading growth. So do you want to maybe talk about how you're utilizing tokenomics to help bootstrap liquidity and just protocol usage overall?
Yeah, happy to. So we do have a VE Pendle token model that is very similar to how convex is to curve. So basically, the TLDR would be Pendle token holders have the ability to lock Pendle for a period from 1 week up to 2 years for added benefits and also boosted yields on Pendle. With VE Pendle, I think it's pretty interesting with how we've built a small ecosystem around locked Pendle. Where we have liquid lockers such as PenPy and Equilibria and StakeDAO that build on top of Pendle, again, similar to how convex is to curve. That's on the Pendle token side. And I think we have been also quite fortunate in getting some of our PT tokens adopted as collateral on other money markets. And that unlocks more liquidity, unlocks more use cases, and makes our different parts of Pendle more useful and more composable across DeFi.
Got it. Yeah, that's fantastic. Getting that token integrated on other markets is not something that can't be. Yeah, it's just super important, basically. On your side, Rusty, how are you guys using? Are you using tokenomics or any incentives to kind of bootstrap use of the protocol, and how do you see that working out long term?
Yeah, thank you for the question. So, yeah, of course, we are using our tokenomics, and actually we are bringing a lot more utilization for I6 tokens in the version 2. We actually have an article covering all this kind of new updates coming with version 2, and we have a lot of interesting instruments there and around tokenomics and around incentivization for the Asymetrix pool users, which will, I think it will allow us to bootstrap our TVL a lot more and become more interesting for the users to hold the I6 token and use it inside our protocol. So.
Got it. Yeah, that makes sense. I think that initial bootstrap phase is important. Like a lot of people, TVL is a super important metric, and people just trust the protocol based on TVL. So I think getting to that critical TVL threshold, whatever that is for you guys, is important.
I can give one direct example if you don't mind. So basically, so what we are going to do in the version 2 is we will allow users who will hold enough liquidity for the ASICs to bootstrap his like a chance to win the prize inside Asymetrix protocol. So it will be one more kind of a layer where you can be where your kind of chances could be multiplied. So it would be interesting for the users. So yeah.
Got it.
That's one of the instruments. Of course, we have more, like everything you can find in the articles.
Got it. No, thanks for providing the example. And so we're talking about bootstrapping. We're talking about increasing TVL. It's the usage of like LSTfi is still fairly small across the space. I think I saw a stat: it's less than 5% of all LSTs are currently utilized within a LSTfi protocol. So obviously we can talk about bootstrapping yield all day long, but that is something that's not sustainable. It's something that works for a short period of time. Like, how do you see the long-term landscape for people using their LSTs, and what's actually going to be the key driver to people just like what's going to take the usage from LSTs from 5% to 50%? Like, what's going to be that key kicker? Because I don't think it's going to, or at least please correct me if you think otherwise, but I don't think that's going to be bootstrapping via incentives. That's like a DeFi summer fix to things. Like, how do you see the LSTfi market growing, and why? Sorry, Ken, go for that one if you want.
Yeah, so I think probably two parts I would think about this. So at the very least, LSTs should have at the base level the same number of use cases as naked ETH in DeFi. That alone would drive that number from 5% to way higher. And I think as specific LSTs get more track record and develop more history and get more Lindy over time, I think with use cases specific to yield-bearing assets, I guess such as yield trading on Pendle and fixed rates, I think more and more can be done versus naked ETH itself, and therefore that should drive that number way higher.
Got it. That's clear, and that makes complete sense. Richard, anything on your side you wanted to add there?
Not particularly. I think, we're going to see, okay, well, yeah, maybe I just didn't want to be too long-winded because we're right at the end of our time spot. But I do think that over time, as the whole sort of area matures, right now we're seeing a place where we're in a risk-off situation. And obviously, as they discussed in the previous panel, you've got rates in traditional finance that are sort of attracting liquidity over to that area. And although we're building, in some places, these real-world asset-backed type yields and bringing them over to sort of on-chain, I think, as that sort of starts to adjust, and as these systems begin to, again, going back to, say, maybe the Lego thing, yes, I agree that the incentives can only take it so far, but I think we'll have to see exactly what happens if instead look at it like during the next bull run, when we're able to attract liquidity back from traditional finance on chain, even if it's just a little bit, but slowly but surely make it more attractive for things to go from traditional finance to ETH staking to LST stablecoin to more yield, and then see at that point where can we make something more sustainable? Because again, it's the bootstrapping. It's what you said. So where do we take it? And I think it's sort of like there are a lot of these different LST-backed stables and other systems cropping up. And I think it's the product market fit, not just between the depositor as market, but the protocol, the LSD protocol as market. They need to go around and look around and find, which of these different things that are cropping up make sense with them as well. And together, hopefully, we can make something that's sustainable and can help keep that liquidity on chain for longer.
Got it. Yeah, that makes complete sense. And I think you touched upon it, and Ken did too. Like, lindiness is something that can't be underestimated here. Like, as well as TVL, people build trust on how long something's been running without any problems. And I think we saw that with LSTs. It took a couple of years before they were really truly adopted and starting getting a lot of institutional adoption. I expect the same thing to happen in the LSTfi space. There was one question which I didn't have time for. It's gone super quickly, and I wanted to ask about how you guys are trying to help in diversify ETH staking, but that can be for another time. That's a topic obviously that's very close to our hearts. But thank you everyone for your time. Appreciate Ken, Rusty, and Richard for you answering all the questions, and let's see how the LSTfi market evolves over time. Cheers, Alan.
Yeah, thanks for having us.
Thank you.
Thank you very much, everyone.
Thank you very much, everyone. I think that was a great panel. Thanks for hosting, Jordan. Thanks for jumping in last minute, Richard, and thank you to yourself, Ken, Rostyslav, for joining. It's been great to have you all. We're going to go for a short break now, and we're going to be back for our third panel with Staking Reward CEO Mirko hosting, and we've got Korn from Yearn, Cruz from Index Coop, and Andrea from Origin. So yeah, thanks again, guys, and we'll be back after this short break. We're back for our third and final panel of the day. We're going to be talking about LSTs and diversifying your risk. So I'd like to bring in the speakers now. This panel is going to be hosted by our CEO, Mirko. And as mentioned before, we've got Korn from Yearn, Cruz from Index Coop, and Andrea from Origin. So I'm going to pass it over to you now, Mirko.
Yeah, perfect. Thanks, Adam. That's amazing. And I think we have a perfect transition here from the last panel. Jordan was just speaking about, how can LSTs help to diversify e-staking? So today we're going to talk in this panel in a group of all of you guys are building LST indexes and aggregates, which is definitely helping to diversify the LST landscape. So I'm super excited to this conversation. And would just like to kick it off with a quick round of introductions to yourself and the product that you're building. Andrea, if you want to kick it off from your side.
Yeah, sure. Just making sure you guys can hear me okay. Perfect.
Perfect.
Yeah, so I'm head of BD at Origin DeFi. Origin's been around since 2017. We're one of the OG projects in the space. We have two flagship products. We have a yield-bearing stablecoin, and we recently launched our yield aggregator called OETH, or Origin ETH, which allows you to get superior yields from DeFi blue chips. And that's kind of in short what we do here.
Awesome. Thanks, Andrea. Korn, do you want to go next from your side?
Yeah, sure. I'm Korn, and I focus on partner and ecosystem integrations for Yearn, and I also run operations for our audit firm Y-Audit. And before this, I spent 10 years building networks and data centers for hospitals, and I've been focused on Yearn now since the end of 2021. And I'm here to talk about YETH, and that is an immutable basket of LSTs that we've been building over the past few months with a go live within the next couple of weeks.
Sure, that leaves me. So I'm Cruz from Index Coop. My title is Ecosystem Growth Lead. Do all sorts of things on marketing, communications, and distribution partnerships at Index. If you're not familiar with Index Scoop, we're the leader in on-chain index products. Been around since the tail end of DeFi summer in 2020 when we launched our first product, the DeFi Pulse Index, which is, of course, a diversified basket of DeFi tokens in Ethereum. Since then, we've gone on to launch leverage tokens like ETH2X Fly, as well as yield-bearing products, IC-ETH and DS-ETH, which we're here to talk about today.
Awesome, thanks, Cruz. And also, like, quick introduction from my side. So I'm Mirko, CEO at Stakewise Rewards, and we are also launching SREs, a stabilized Ethereum staking yield index. That's gonna go live very soon in collaboration with SpoolDAO. And yeah, so I would love to kick it off and just kind of go back to the basics a little bit and ask you guys, like, why do you guys think people should invest in like yield aggregates or LST aggregates indexes instead of native LSTs? And what do you think are the most important factors that users should consider when choosing a certain LST aggregator index? Cruz, if you want to go from your side first.
Sure. Yeah, I mean, I think diversification is one of the most important things when you think about your portfolio and your holdings. You know, you don't want to open yourself up to you know, some idiosyncratic risk with one protocol just wiping out your portfolio. And the Ethereum network certainly should feel similarly, where we shouldn't be relying upon one staked ETH product. You know, I'm sure we'll talk a fair bit today about, you know, Lido's position as kind of the largest liquid staking token. You know, when we set out to build diversified staked ETH, we felt that users or holders, you know, really should want to diversify their portfolio, but Ethereum itself should feel the same way and not relying upon only one liquid staked ETH token to carry the load for the whole network, because we believe liquid staking is the strongest or the best way to stake for users. It just makes the most sense. It has the best value proposition. And it's important that minority liquid staking tokens are able to, you know, to find distribution, to find users. So by creating a liquid staking index, you know, you get the best value proposition for the user and diversifying your risk and help the network out, doing a great service, you know, offering more liquid staking tokens to users. And I'll let the others chime in, and we can go around a bit on what makes, you know, a good liquid staking token, why invest in an index, what's important. As everyone, I guess, when you create an index, you got to decide what to include and what not to include, right? That's, of course, the most important part.
Yeah, definitely. I think, like, Corn, you guys from YE had like a unique approach of like which LSTs to include in the index. Do you want to give like a quick introduction to that, like how you guys are choosing which LSTs to include in your index?
Yeah, so we had a bootstrap event to determine the first 5 LSTs that were going to be in the basket. And YETH is very similar to a curve pool with like a multi-asset curve pool, like 3Curve, for instance. So we're actually going to be mimicking or following the curve 1 month epic schedule. And in each epic, the basket, the participants of the basket are able to provide incentives to inspire voting for the weights of the basket. And each weight can be no greater than 33%. So there is a ceiling to each one of these. And with the first voting, the first 5 LSTs in the basket, I think were pretty balanced out. I think the max for each one of them, or the highest weight for one of them, was like 22%. So that's how it was laid out in the bootstrap. And in each epic, up to 1 LST can be added, but it's not guaranteed that a vote will like be passed for adding an LST each epic, each month-long epic. And there's a maximum of 26 that can be added to the basket in full. So we're kind of like, the analogy that I've been using is we're building a ship and we're letting it set sail. And the people who are going to navigate the ship are the staked YETH holders, and they're going to determine the direction for this. And I think it'll mimic what the market thinks the weight should be. And the most important thing that we've kept in mind through the design of why ETH is for it to be used as good collateral for like lending protocols and for CDPs and stuff like that. We think that utility is extremely important, and that's going to lead to adoption.
Amazing. Yeah, I mean, that's kind of the main value proposition of liquid staking in general, right? Like having the liquidity in the market and having it as a real utility and so on. Do you see like that liquid staking aggregates can be used as like a widely adopted collateral in the ecosystem, or like what needs to happen for like other DeFi protocols to accept the index token instead of like a native liquid staking token?
Well, the basket has to have the qualities of good collateral, meaning it has to be very liquid at all times. And the way that this was designed as basically YETH being the LP token of like a similar curve pool, these can be burned or unwound instantly, and it'll be done in a way that the user will redeem to the existing weights of the underlying LSTs, or say in like a 3 curve pool, you were to withdraw like as a single asset like USDT, based on the weight of the LST that you are exiting with, you will either be bonused or penalized based on that. So we're also going to have a VYTHI gauge for the YETH ETH curve pool. So that is another way that they'll be able to exit. But this is redeemable, good collateral, and that's one of the important parts of the design. And of course, you're going to need to have those channels also. So those partnerships with all of the lending protocols and the CDPs, and like that's always been a strength of Yearn, because Yearn Vault tokens have historically been a really good form of collateral for CDPs like Abracadabra and other projects like Alchemix too for self-paying loans. So we have those channels also.
Awesome. Yeah, that makes a lot of sense. And I'm keen, like Anurag, from your side for like OEs, what is your strategy for like what do you think is that the best use case also for like for example OEs to be like widely adopted? Is it also like establishing it as collateral, or just for people to like invest directly into it? Like what's your approach to it?
Yeah, I think it's both. In the LST space, I don't think that you can succeed without having deep integrations. So I do think that it's necessary for almost all LSTfi products to integrate deeply into further protocols for utility. But for us, OETH makes sense even as a standalone product. So without further utility, OETH is positioned as an additive solution to its underlying LSTs. So at the moment we support only 3, but over time we want to open it up. Well, it's actually already open to governance, so anyone can submit a proposal to be supported as collateral, and we would just integrate them into OETH, and you'll be able to get additional yield on top of that. So really OETH is perfect for those who want passive yield. It's really just the same narrative that we took from OUSD, which is, active farmers waste a lot of time, a lot of resources, gas fees, etc., in searching for the highest yield. But with something like OETH, you can simply hold it in your wallet passively and get the best yield from blue chip LSTs passively. So that's kind of our thinking around it. Of course, we're looking to integrate as much as possible to allow others to add even more yield on top of the yield that OETH generates, right? So this is obviously a different risk profile, and it's not for everyone, but it should be available to those that are interested in it.
I would say the index scoops kind of strategy with DSE more closely mirrors the OETH strategy, where we want it to be available as a standalone product. That the key value proposition we're going for is just simplifying users' staking decision, right? Save you time, save you gas fees, so you're not looking through all of the whatever liquidity pools and the long tail of yield options and the degen side of DeFi, where you just want a dependable ETH staking yield that you can hold, you can feel solid about. You don't have to wake up in the middle of the night worrying about. You don't have to check Twitter on weekends and whatnot. Make sure your yield is staying, the most competitive, and you're accruing the most incentives. We're not chasing those. We just want a dependable option that people can, we're really going after people that like they know they want to be staking their ETH, but they're not sure what to believe in all of the like tribalistic rhetoric. This token's bad, don't do this one. You need a more decentralized one. You need to be in this liquidity pool. You need to bridge it over here. I just want to take what the network's giving me. ETH is an incredible asset. The fact that you can stake it and earn a yield, participate in the network is an amazing, powerful thing. We just want people to tap into that, right? We want to expand the amount of people staking their ETH and give them a simple option they can feel good about. Integrations are great. Well, of course, we want to pursue all the integrations we can. But the way we've approached it so far, we have not every single component has a Chainlink Oracle, which can reduces your amount of options. You're not going to be able to list your index token as collateral on Compound or Aave without that, given their robust security requirements. So I'm really curious to see how Yearn's YETH rollout goes with all the integrations and see what kind of momentum it gets, because Corin's right. Yearn has been, absolutely a leader in ecosystem and integrations. So I'm really excited to see how it goes and how we can expand the total market for LST indexes.
Awesome. Yeah, it seems like a pretty no-brainer actually to like invest in diversified LSTs instead of LSTs because you do want to have the exposure. I guess the one question or consideration for a lot of users is like the fee structure, of course. So it would be great. We can do like a quick round maybe for all of the three of you guys to like just do a very brief intro to like your fee structure and how do you think, that plays a part in the user's decision to use the liquid staking index instead of native liquid staking. Do you want to go first, Corn, maybe from your side?
Yeah, sure. It's just I think it's a 20% performance fee. So it's similar to all of the non-factory vaults that Yearn has. And what that means is each time that there is a harvest, when the profits are taken, it's split 80% going to the users and 20% going to Yearn, and that's it. That's the only fee.
Cool. Yeah, I guess I'll jump in. For us, it's also 20% of the yield generated that currently is used to buy CVX bribes. So I don't know if you know how ETH is structured, but basically we're leveraging curve and convex rewards through something called AMO in order to generate our superior yield. So at the moment, the 20% is used to towards that mechanism. But in the future, we want the 20% to go towards users. We as a protocol don't keep anything.
For DSETH, we have a streaming fee of 25 basis points. So 0.25% accrues annually. So to put that into perspective, if you hold 1 ETH worth of DSETH, that's about $4 per year you're paying in fees for the index. We felt like we wanted to make sure we had some fee on the products. We want to make sure we're building a product that people are willing to pay to use. Otherwise, I'm not sure that you really have a value proposition that users want.
Sounds great. Yeah, that's definitely 3 unique approaches. And yeah, I'm keen to see how that works out and everything. I'm keen looking a little bit into the future. Where do you see, or what do you think is the end game for LSTs in general? Do you think everyone will invest in LST indexes, or how is that going to play out also with Lido having a lot of market share right now? How do you see the future, and how what do you think the landscape will look like, let's say in the next 2 years or something?
Yeah, I can jump in. So I don't think that there's going to be a winner takes all market. I don't think that that's realistic. Obviously, there's different risk profiles and also different perception of the space. So what that means is that Lido currently has the biggest market share, of course, But that doesn't necessarily mean that it will change in the near future. So I speak with a lot of institutions on a regular basis, and they prefer Lido just because it's because of its risk profile, right? So when you deal with LSTfi products or aggregators, then you're taking on additional risk, and every single integration, every single additional collateral, every single smart contract is additional risk. So there will always be a portion of the market that's risk averse and it prefers something like Lido just because it's a little bit more straightforward, maybe also because of the depth of its integrations. I think it's going to take a while for us to catch up with the number of integrations that Lido has. So that's one side. However, I do think that during a bull market, we see a risk on market, right? So we see a completely different risk profile, and people are searching for that additional yield. I mean, we saw at Origin DeFi for OUSD, not OETH, but our TVL jumped to 300 million pretty much overnight once sort of the markets changed. So that's what happens when everything changes from a risk perspective. So I think that all of the LSTfi products or aggregators will see tremendous traction as the market changes as well. I think that macro influences a lot the direction of all of these products.
I think we'll see a lot of adoption too. And she's right. Like it's going to take some effort to catch up to where Lido is today. And I think even just among the three of us here on this panel, we each have our own unique value propositions. And, one of those value propositions that I think will be successful also in the future is getting a new audience of people who are looking to get into LSTs, but don't have the same risk profile as the typical degens. And I think that growing that audience is important. It'll happen.
Yeah, absolutely. I think I'd agree with Corin there. And I think now that withdrawals are enabled, all of these more upstart LSTs are on much more stable ground to take market share from Lido, right? Staking has been significantly de-risked. They've got a much more firm platform to stand on. And we are starting to see some of these challengers grow. For one, Rocket Pool and Frax come to mind. And then kind of some of these more upstart ones that are getting ready to ship. Stakewise V3 is one that comes to mind. Like these people have a chance now to really to build a good product and gain some market share. And then I think definitely, when we see a new market cycle and a new audience come in, there's some chance that those more upstart LSTs as well as our index products could be in, it could be right next to Lido in some of these new distribution points, whether it's, kind of more fintech products like maybe a Robinhood type of thing, that it's going to see a lot of new users come in through these new distribution points. We're going to have a chance to be right next to Lido, and these new users will, won't be picking Lido as the default the way that the institutions are, the way I think Andrea mentioned, where they just prefer Lido for now because it's more lindy, it's deeper liquidity, it's bigger, it seems safer. Finally, these other ones have a chance to be right next to Lido and have a solid chance.
It's really impossible to know like who is the most risky and who isn't, because after all, like Lido is a product that consists of smart contracts too, and you don't know who is the most risky and who is the safest, like until something goes wrong. That's the point where it all happens, and those risks, they can be key management. They could look like for multi-sig management, they could be slashing events, and like those are all single points of risk, and they need to be diversified. And I think there's an audience of user that isn't in this ecosystem yet, but will be coming, that finds a lot of value in that.
Yeah, I think all else equal, one would probably prefer the diversified option. There's some constraints and some hurdles and layers of smart contracts right now for making those options seem equal. But yeah, all else equal in a curated environment, a brand new user coming in through a centralized exchange or a fintech app, they're likely to resonate with diversified staked ETH versus just staked ETH in the future.
Yeah, I think it's all about perceived risk mainly, not about the actual risk, because the risk is so hard to assess in general. And I mean, it makes sense for institutions to just like go with Lido as a default kind of, because it has the highest reputation, it's most well known and so on. But yeah, like how do you guys see like have you ever approached institutional investors, and like is that something that you're targeting, or like you said mainly like there's a new type of user group coming in for these LST indexes, so it's like between like, let's say, risk averse institutional investors and like DeFi degens. So you think this is the main target user group for LST indexes, or like is there also a chance you think for institutional investors to jump on those type of products?
Yeah, I guess I'll jump in since I mentioned institutions before. We are speaking with institutions, and I guess we'd have to step back and figure out how do we define institutions to begin with. A large, depending on the audience and how knowledgeable they are, they think of institutions as like established banks, like, you know, the JP Morgans and those like really like slow movers that are incredibly risk averse. That's obviously not who we're targeting or who we're talking with when it comes to the LSD space, just because they're barely in crypto at all. They're just very adjacent to it. And from a regulation perspective, they cannot get involved. But even a DAO can be considered an institution depending on who you speak with and how you position it. So yes, we are speaking mostly with crypto native institutions. For us, the qualifier is, do you already own ETH? Because we don't think it's our job to educate these institutions on like buying ETH to begin with. That's just like a very long journey and an incredible waste of time for where we are as a company. But maybe someone like Lido has the time and resources to do the education on like why you should buy ETH, right? For us, it's do these institutions already own ETH, and are they earning yield on it? Now, obviously, every smart asset manager gets yield on their products. That's a no-brainer. And now the question is, how do you sort of fragment this institutional market of players that are already getting yield? What are their risk profiles? So we try to categorize them on different like risk buckets, and then just look at what would get them to get an interest in ETH. And this is really, there's no recipe here. It's more of like trial and error, speaking to those that we intuitively know would be interested in this type of product. And then just going through the process of seeing if they would be interested in purchasing it, or what the pushback is on something like ETH, and kind of adjusting along the way.
That's a good way to find the qualified customers quickly. I can imagine there's a lot of noise out there if you don't do that.
Yeah, I mean, like I said, it's if you're going after like family offices, they're like, yeah, we've been thinking about buying our first ETH, but we don't even have custody set up, then that's like a no for me. I don't even pursue that lead anymore. It's like, great, talk to you in 2 years, because just getting custody set up takes like 6 months to a year, historically speaking, and we don't really have that kind of time. Obviously, we're a small startup. We have limited resources, so waiting around for these types of leads is not productive for us.
Yeah, I'd agree. You go after folks that already have ETH, and to be honest, the people that do already have ETH are more, we classify them as like agile funds. A lot of times they're kind of hedge fund, family office types that are already sort of crypto native. To be honest, even in that class, the demand for leverage has been higher than the demand for diversification for us. So we have a leverage staked ETH product that has seen a lot more activity, inflows, and discussions than the diversified staked ETH ones. We have seen some interest in some larger, which could classify as institutions purchasing our diversified staked ETH product as well. But yeah, to be honest, the demand for leverage has been higher than diversification in the staking game. But obviously, market rates have changed. The leverage staking trade isn't as much of a no-brainer anymore. So it's starting to change. And on the ETH yield game, I'd say for some of these larger institutions, the 4% staking yield of ETH looks inconsequential when you look at the volatility of the asset. It's like, okay, if I just buy on a down day, there's my 1 year's worth of yield right there. So as ETH becomes less volatile, staking yield becomes more worth your time to pursue and make sure you're collecting.
So what would be the difference in user groups between the leveraged staked ETHs and like the diversified staked ETHs for you guys? Is it like the leveraged stake is like mostly like, much more like DeFi degens, or how does the difference look like there?
I mean, I'd say for one, the the leverage staking trade is less of a no-brainer now, and you're more likely to just use a single liquid staking token if you're pursuing the leverage staking trade. Diversified leverage staking trade is, you know, too many layers of probably not worth doing. Yeah.
Cool. Awesome. Yeah, I mean, we are already out of time here. Really appreciate you guys being here. It's been a really great panel, talking through everything and a great summit in general. So we're just going to wrap up the LSTfi Summit for today. For everyone listening, check out the Staking Summit happening in November in Istanbul. It's an in-person 2-day conference for like just bringing together the staking industry, like all sorts of validators, staking providers, LST protocols, node providers, all the big proof of stake chains will be there, staking smart contract and so on. There will be around like 800 to 1,000 people. So yeah, you can still get your tickets, and then hope to see you in Istanbul in November. Thanks, Korn, Cruz, Andra, for the great panel. And thanks for everyone listening, and see you at the next time.
Thank you for having me.
Yeah, thank you.
Bye.